For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Also, 6 popular investments for retirees. When do they make sense and when to stay away? Also, 5 blind spots that could derail your retirement. Finally, retirement reality. We'll talk about that and more. My name is Jeff Shade, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Randy and Jake Floyd of Floyd Financial Group. Randy, how are you this morning?
Doing very well, Jeff. How about you?
I am doing fantastic. And Jake, how are you?
I'm doing great, Jeff. I'm just glad it's not summer anymore.
I know. Fall is upon us here. Temperatures have already begun to drop a little bit, so this is going to be your favorite time of the year. When summer turns to fall, and I think even a better time of the year is when fall turns to winter. But guys, in honor of school starting up again this week, I thought I would share an assignment a 4th grade teacher gave to her students. Now, the kids are about 9 years old. She asked them to complete some well-known proverbs logically. And every year she begins the year with this assignment. She's Mrs. Leslie Vick of Westlake Village, California. Now, here's the beginning she gave them, and here are their answers. So if you're ready, strike while, and the kids wrote... The iron is hot is what it should be, but the kids wrote, while the bug is close. That makes sense to me. Next one was don't bite the hand.
That feeds you.
Don't bite the hand that looks dirty.
Also good advice.
That's right. You know, these kids are making a lot of sense here. You can't teach an old dog
new tricks,
new math. Makes sense, right? Next one is an idle mind is the best way to relax, is how they finish that one. Better late than absent. A penny saved is not much. And I love the last one here. The last one is my favorite. Now, keep in mind, 4th grade, about 9 years old. A bird in the hand is better than a woodpecker on the head.
I have to say, what strikes me about a lot of these is how much more sense it makes than a lot of the liberals in Congress.
I know, doesn't it, though? I think Trevor is starting up school this week, isn't he?
Actually, he did last week.
Oh, okay.
He did last week.
All right. So what grade is Trevor in these days?
So Trevor just moved into 8th grade.
Oh, wow. He's a big guy now, getting ready to take over Floyd Financial Group pretty soon. Well, anyway, let's get into current events here. A lot of stuff I've been hearing on the news this week. Rate cut speculation. Jay Powell spoke in Jackson Hole, Wyoming. The stock market ticked up a little bit based on what he said. Now, what have we had? 4 or 5 meetings? He hasn't cut interest rates. Do you think that there's any chance he'll do it? And if he does it this time, by how much?
Yeah, so I think that we're good for a 1/4 point cut here. Now, there's some stirrings around some of the members of the Fed, and there's some things that could potentially derail that. There's some things that could potentially make him go 50 basis points. But I'd say that there's probably a 95% chance of him cutting 25 basis points. Now, what will be much more important than that is his overall sentiment and thoughts and statements about forward-looking policy will matter more to the market than the actual cutting of 25 basis points. In fact, if he is hawkish on more cuts, meaning he's like, well, here's one cut, but I don't know if we're going to cut again, I would expect the market to dive on that news. And so it'll be an interesting moment because Powell is trying to maintain his stiff upper lip in the face of Trump's pressure. And let's be honest, Trump can put a lot of pressure on these guys. And I think he's going to try to be defiant if he can, but not disrespectful. And I'm not sure how all that's going to play out, but that's basically 2.5 weeks from now. I'm going to have my popcorn ready and the TV ready. Yep. So it'll be interesting to watch for sure.
Yeah, well, I think it kind of indicates or could indicate a sea change, if you will, if he is not really vocal about maybe the future. We're not sure how that looks. Mm-hmm. If he stays away from that language and just says, okay, yeah, we're going to go 1/4 point, and then we'll go based on data, The market's going to like that, and I think we'll continue to see a little rally.
I mean, again, though, it's almost a 50-minute grilling, and they're going to ask him that same question 40 times from 40 different angles, and I don't know that he'll be able to not give something away about what he's feeling about. If you look at the jobs data, which is one of their 2 mandates, right? Just for those who are unfamiliar, the Fed's 2 mandates are maximum employment and price stability. So maximum employment being as little unemployment as possible, and then price stability, meaning we want a little bit of inflation, but not very much, and we don't want deflation. And adhering to those 2 things, what they're really concerned about right now is the jobs market. And the jobs market is still better right now than it has been 95% of our history, but it is starting to see some ticks higher in unemployment. A lot of that is due to artificial intelligence. If you're a longtime listener of the show, you know I've talked till I'm blue in the face about how AI is going to put a lot of people out of work. But I do think that, it's not something to be super worried about on the macroeconomic level, because it's going to generate profits, which will generate returns and things in the stock market, but just prosperity overall as people make more money in the market. And if we do have deflation, the Fed will keep cutting rates, which brings the 30-year mortgage rate down, which means people buy houses. When people buy houses, they fix up their house, which drives profits for Home Depot, which means their stock goes up, which means the market has more money, and then they use that money to go buy a bigger house. And there's this kind of wheel effect that happens. And I think that that's what's largely being discounted in most of Trump's plans. There's a lot of economists not giving him credit for the fact that this is going to drive business. As it drives business, it drives profit. As it drives profit, it drives more housing prices. That really benefits everybody except people renting with no investments.
Right.
Again, if that's where you find yourself, you can always save a little bit of money. That's one of the things we're going to talk at length about in our last segment today. But So I don't want to get too far ahead of ourselves here, but people who are invested over this next 5 to 10 years are going to find themselves, I believe, in tall cotton.
If I'm hearing you correctly, Jake, what you're saying is these rate cuts will have a trickle-down effect. Now, you'd mentioned the mortgage interest rates, the 30-year mortgage interest rates. 25 basis points may not affect that too much, but I've talked to people who said, boy, I really hope that these rate cuts happen because it's going to make the mortgage rate better because I want to sell my house. Maybe somebody can buy it. But the mortgage rates are really a direct result of bond yields. Do I have that right or not?
Well, that and the Fed funds rate, which directly affects the bond rate.
Okay.
So they're intertwined for sure.
It's definitely one of the inputs to interest rates. However, so when it comes to bond yields, the Federal Reserve Fed funds rate is definitely a major input cost. It's the 8,000-pound gorilla in the room, if you will. But it is not the only thing that matters. And to your point, Jeff, the bond market can front run a lot of the moves in interest rates. If we have concerns about the jobs market or the stock market, we might see yields go down even before the Fed moves. But conversely, if we have some kind of a bond crisis or something, we might see interest rates go up even if the Fed doesn't move. So the Fed funds rate is not the only thing that matters, but it does matter quite a bit. And the Federal Reserve Chairman is a very, very powerful person when it comes to economics. And I think over the next 6 months or so, we're going to see the phasing out of Jerome Powell. And the next Fed chair is likely to do Trump's bidding, I think, more or less. And some people hate the idea of that. What I would say is that Trump is very concerned about how much debt service we have. And so am I. So the first time Trump was in, we had about $300 billion a year in interest on our debt, which sounds like a lot until you compare it to what we're paying now, which is almost $1.3 trillion a year in debt service. And so Trump correctly understands that the big issue here is how much we're paying on our debt, not if we have an extra 1 or 2% inflation. That's a very small problem compared to paying $1.3 trillion a year in debt service. Frankly, a lot of that money going here in the States, but some of it is going to our enemies who hold our bonds, like China and others. So that's a much bigger issue in the grand scheme of things. And that's why we may even see the Fed get reworked on its mandate or exactly what it does, because right now it's totally ignoring those things because it's only focused on its dual mandate. Now, again, a lot of economists applaud that, but it's very obvious to anybody with any economic training that we should not have rates as high as they are right now, and simply cutting those rates would be saving us hundreds of billions of dollars a year in interest.
Yeah, I think also there's one other thing that needs to be brought up. We saw for a long time, Jake, that we had low inflation with good numbers in the market. And today, all of a sudden, nobody can ever think back to how that used to be. It's just that if you make money too easy, it's going to drive inflation. And we just didn't see that for a very long time back there. What really, again, and we've said this over and over, and this is pretty basic, but supply and demand is what drives inflation. And so with all the investment that Trump is bringing back here and plants being built here, I mean, just building the plants puts people to work. Just because markets are hot doesn't mean that they're going to be inflationary. But when we have too much money in the system, i.e. the $6.5 trillion, and then we send people home, it takes a long time to clean up that mess.
We're talking with Randy and Jake Floyd Financial Group. Of course, our show is called Show Me the Money. Before we end this segment, I want to talk about District of Columbia, D.C. It is getting cleaned up, and people are pretty happy about that. Can you comment on that? And maybe this is a trend that's going to expand to some of our other major cities. I hope so.
There's a lot of people applauding the fact that we're not, hey, we know that you stole this stuff, or we know that you beat this person, and we're going to give you no bail and send you home and make you do 50 push-ups tomorrow morning or whatever. Yeah. I mean, it's just been ridiculous. And so I think people are welcoming the fact that, you know, if you're a criminal and if you are going out and stealing and pillaging, you need to pay some consequence. Because here's the thing about it, Jeff. People are just grown-up little kids, right? So if you're a little kid and you start doing things and there's no punishment for those things that you were told not to do, how soon will you go back and do them?
Yeah,
will you go back and do them right away?
Right away. Yeah, I point to the parenting, too. It's like, okay, the parents are not much better than the kids are, and the grandparents not much better. But as a kid, and I'm sure that you were the same way, Randy, we learned right from wrong pretty early in life, and there were consequences.
Yeah. And my dad taught me by applying, guess what? It was called corporal punishment.
Oh, yeah, I remember.
I mean, when he started to reach for the belt to unbuckle it, I knew it was time to run.
You know, this is such a welcome thing. It's hard to believe that we got to the point where you could go out and commit these crimes and you would not be punished for them. And it just snowballed and snowballed. And then it was like, well, why do I need a job? I can just hang out in the street and somebody will pay me to live. And it's just very much gotten out of control. The quality of life in these big cities has deteriorated so much, and it is expanded to the middle cities as well, too. And it just had to stop someplace. So I think it's very good that what is happening in D.C., do you think that it's going to spread to places like San Francisco and Seattle and New York and, you know, Boston and some of the other big cities?
Yeah, I would say that he'll probably stay away from California for a couple of reasons. Number one, I think Trump might think that they don't deserve the help. But number two, Gavin Newsom would throw an absolute hissy fit.
That's terrible. That's awful.
How could if he went in there to help people.
How could you object to making your city a better place?
Trump's going to probably go to the places that ask him to come first, especially there's a lot of people in Chicago kind of begging him to come do the same thing in Chicago.
Sure.
Now, obviously, the leadership there doesn't want that, but it is fascinating to me that people are like, no, don't do this. It's fine to just kill people in the streets and let 14-year-olds kill people and not go to jail. That's insane to me, especially when it's happening as the crow flies a mile and a half from the White House. I think what he's doing is generally good. Is there a better way to do it? I don't know, but clearly D.C. had no intentions of fixing it. The mayor had no intention of fixing it. And so he had to do what's necessary. I mean, the National Guard is there on reserve for occasions such as this. I mean, that's why they train. That's why they get paid. That's why they're in reserve to handle situations like this. And we're seeing even some of the locals in those neighborhoods are now walking around the streets going, I haven't been able to walk the streets safely in decades.
Right.
And I'm walking the street now and I see police everywhere. And I know that if somebody comes to try to mug me or shoot me, I can just yell for help and they're right there to help me. It's amazing and appalling to me that there's places in this country where that's not the case. If we were in the street here, people don't commit crimes in broad daylight. Why? Because criminals get held accountable. Now imagine this for a second. Imagine that when people commit crimes, we put them in jail.
Ooh.
We arrest them, and then they go to prison because what they did was bad. And then imagine that everybody's mystified that crime goes down. I mean, it's just like,
It's amazing.
it's total common sense. And I think what's amazing is how quickly it's helped the area over there. So I do think you'll see more of it, Jeff, to answer your original question, but I think it may be Chicago, Baltimore, places like that, maybe even New York City. I doubt he's going to probably go to Washington or Oregon or California and some of those places that would fight him every step of the way.
Right. Well, I lived in Seattle for a while, and it's a shame you're surrounded by such natural beauty, but still, when you look down, you've got to avoid stepping on a needle. There are homeless people who are relieving themselves on the sidewalk in front of restaurants. You can't even go there, and there's a lot of crime. So I think this is a step in the right direction. Talking with Randy and Jake Floyd Financial Group. Our telephone number, 417-889-7233. If you'd like to come and sit down and talk with Randy and Jake about your financial portfolio or your frustrations with life, pretty much anything. We can talk about almost anything. No cost, no obligation, no judgment. 417-889-7233. Make that call today. Let's take a break, Randy and Jake. When we come back here on Show Me the Money, we're going to be talking about 6 popular investments for retirees. When do they make sense and when to stay away when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about 6 popular investments for retirees. When do they make sense? When to be cautious?
And Randy, let's start with the first one on the list. It's CDs and savings accounts. Retirees, they often like them because they feel safe. But when do they make sense, Randy? And when might they actually hurt people?
Well, it's funny you bring that up, Jeff, because recently we've seen that CDs, money market accounts, and things like that have done pretty well because of the fact that starting in March of 2022, Jerome Powell, our Federal Reserve Chairman for the time being anyway, raised interest rates from basically 0 to 5.25% over about 14 months. And so CDs paid 3, 4, 4.5, 5, 5.25% there for a while. And that's the most they'd paid in years and years. And so people were pretty happy to have those. And what's great about them is they're pretty liquid and you don't have to tie money up for a long period of time. You know your money's going to be safe and you're going to get the interest that they pay. However, under more normal circumstances, when yields are 1, maybe 2, and 3%, there's better places to go and get retirement income than with a CD. So sometimes you're actually losing money over the long haul. In fact, you were for many years when CDs were paying 0.5% and 1%. You were losing to inflation. So maybe not for the long term, but hey, when rates are high and, for some money that you want to keep liquid on the side, it's great.
That's a good point, Randy. There is a trade-off for safety in terms of the return that you get. It may not be as much, but if safety makes you sleep better at night, maybe that's the way you go. Let's talk about dividend-paying stocks. Now, some retirees like them for income. What's the benefit and what is the risk to them?
Yeah, well, basically you have 2 types of companies, those that are in strong growth mode and those that have been around for a while and have great businesses that make great profits. And so many times those will pay a higher dividend while some of the growth stocks pay no dividend whatsoever. So it's one of those things that if you like a steady stream of income, and I talk about this a lot in some of our meetings, we have volatility and we have risk. When we look at risk, if you bought Rivian when it was $112 billion in valuation and now it's 10% of that, you understand risk.
Yeah.
If you bought Microsoft or if you bought somebody like Procter & Gamble or maybe you bought some utility companies that pay dividends, yes, we had volatility in the market, and markets have rallied back quite a bit in all those segments, but you maintained your income for the most part across that volatility. So that's why a lot of people like dividend-paying stocks.
Dividend-paying stocks can pay their dividends every 6 months, or they can pay them quarterly. Do you get more money with a dividend-paying stock? I think a lot of people think, well, I'm going to get this, and then at the end I'm going to get this. But isn't it basically, and correct me if I'm wrong, the same amount of money? It's just that they pay it more frequently, let's say.
The way it really works is the board comes together and decides what they're going to pay in a dividend and if they're going to. And so these companies that pay monthly, probably quarterly or something like that, I would say quarterly is when the board is really looking at profits and all that stuff, just when they report to us like they do every quarter. After that, the next 30 to 60 days, we get all the earnings from the previous quarter. They're looking at dividends and whether or not to adjust those. I will say this, some of the companies have gone to more of almost a profit sharing dividend structure. Some of the oil and gas companies have done that, which is kind of interesting, meaning the more profit the company makes, the bigger the dividend. And so that might be something that's going to catch traction in the future.
And you said if they pay a dividend paying stocks don't always pay a dividend, do they?
Not always, but I will say this, that again, it tends to be more mature companies with a steady bottom line that's going to pay the dividends versus a growth company like Starbucks. I don't know if they pay a dividend yet or not. They might pay a small one, but for years and years and years and years, the only way to make money at Starbucks was to buy low and sell high.
Right.
And so that's the other side of it. So when you have a dividend paying stock, your stocks prices may run up some, but if they're going to pay the dividend, if it's a solid company and it doesn't have a lot of growth potential looking forward, in other words, it doesn't have a lot of multiples coming down the road in growth, the dividends are going to affect what the long-term growth of the stock price is going to be.
I think a good example of this that a lot of people know around here is O'Reilly. So O'Reilly has never, ever paid a dividend. However, O'Reilly is up like 200-300x, meaning like 20,000% over the last 20, 25 years. So think of it this way. If you're always returning capital to the owners of the company rather than reinvesting it in the business, there's nothing wrong with that. But your business is simply not going to be as big as if you're reinvesting every dime back into your business. And so other notable companies that have never paid a dividend, Amazon, some of the other tech companies pay a very small dividend, but it's very small. Like I think NVIDIA's dividend is like 0.16% or something like that. Last time I looked, Apple pays a very, very small dividend. But some of that's just to be able to say that you do. Walmart pays a dividend, but it's also very small. So if you're going to invest money back in your company, you're always going to have a bigger company. And for the most part, when it comes to stock prices, on average, your total return, meaning how much the stock goes up plus the dividend, is generally going to be higher in growth companies that don't pay dividends than in companies that are always returning all the money they can to shareholders right now. That doesn't mean in every environment it's going to be better to have growth companies for sure. And it's generally good to have a blend of these things. But it is important to understand that companies that pay dividend are, like Randy said, generally more mature, kind of at a later phase. They're kind of out of growth mode. And a lot of companies really start paying big dividends when they can't think of anything better to do with that money.
Okay.
Right. And so instead of letting it accumulate in the account and they don't have any more R&D to do, they don't have anything else to invest in, then it goes back to the shareholders.
That's the beginning of the end sometimes.
Well, it can be. Now, again, like ExxonMobil's been paying a dividend for, I'd guess, 60 plus years in the base company, and they're still here. They're still moving and shaking, but certain sectors are also expected to pay dividends. Utilities companies and oil and gas companies are like, if you don't pay a dividend, you'd be the major outlier there. So anyway, just some color there.
Talking about common investments, when they make sense and when to stay away with Randy Jake Floyd Financial Group. Let's move on to bond and bond funds. These have always been considered conservative. How do they fit into a retiree's portfolio today?
Yeah, Jeff. So when we look at risk, they call it systemic risk of being in the market, whether it be stocks or bonds in general. The bond market is a huge market. In fact, it's bigger than the stock market in general. But when you own a bond fund or a bond, you own the debt of a company versus when you have equity, it's when you own stock, right? So traditionally, they're more stable. So if we have people that are looking for income and don't like volatility, a bond or a bond portfolio of some sort can be a great place to go. On the other hand, when interest rates are higher like they are now, if we were to go in and buy bonds, not that interest rates are extremely high, but they're higher than they have been looking back over the last decade and a half when we look back over our shoulder. When bond yields are fairly high and yields are probably going to be pushed down as Jerome Powell maybe takes interest rates down, that can also give you a little extra return to the top side. You get your dividend or your interest payment, but you also get the appreciation versus if you buy a bond when bonds are paying 2% and they go to 3 or 4%, now your bond has a potential of being devalued. So right now, is a pretty decent time to mitigate risk, get a decent yield in a bond fund, and maybe the promise of some extra money because of interest rates being pushed down in the future.
All right, let's move on to mutual funds and ETFs. They seem to be everywhere. When do they make sense, and when should retirees be careful?
I don't know how many there are. At one point, I knew there was 29,000 mutual funds, but I think there's probably more than that now. I don't know what the number would be. But basically, mutual funds are a very big part of everyone's 401k plan, which is really where I think they've been around since 1930. One of the first mutual funds was put together back then. Basically, a mutual fund is just a grouping of stocks that a company holds that people buy into and hold mutually with each other, right? So everybody gets the same value at the beginning of the day, at the end of the day, depending on what the market did.
Globally, there are 137,000 mutual funds now.
Wow.
Globally now, Jake says there's 137,000.
Wow.
Woo! Well, we should pick one.
That's a big number.
Anyway, we don't use mutual funds that much anymore. In fact, hardly at all. Very rare cases where we do. We use exchange-traded funds because the cost is less and we get to control when people pay capital gains rather than when the mutual fund company decides that they get to pay capital gains. But like I said, the 401k is where most of the mutual funds are hanging out and residing today. And I will tell you, that's where a lot of the money in the U.S. and globally is parked right now, are in these mutual funds. One of the things we're always looking to help people with is, hey, how can we do something maybe more efficient with that money and get you a better return and save you some tax money as well?
Okay, so we prefer the exchange-traded funds or individual stocks. So let's move on to the hot topic, annuities. This is one that people talk about. When do they make sense and when don't they?
Yeah, so annuities probably got a bad name starting in the late 90s to the early 2000s when there were very few companies doing those. And of course, if you remember from 85 through like 2000 when we had the big .com bubble, I mean, stocks grew like 1,000 to 1,500% over that time frame. And people were funding their 401ks, funding their IRAs and maxing them out. And variable annuities were a very hot thing in those days because I could put money in there and I could tax defer my growth, and the market was growing at 15, 20, 30% some years. And so to pay a 2 or 3% fee to have a variable annuity was nothing compared to the taxes you were paying. But as things came around full circle and got back more to normal, people started looking at fees. And so variable annuities alone got a pretty bad rap, and rightfully so, with some of the fees that they were charging. And then came along fixed annuities and fixed indexed annuities and a lot of water under the bridge. I would say today that more than ever, if you are careful, and we are careful here at looking at all these, we have annuity contracts that can make very good sense for retirees to mitigate risk to the downside while returning good upside. But you have to be careful and you have to be selective as to what you use. One of the biggest myths about annuities is, hey, once I put money in there, I can never get it out because if I died, my family gets nothing. We don't use anything like that. Those things still exist in some cases. They're normally used to set up pension funds. But again, all these have beneficiary designations today and can be passed to your beneficiary. So I want to kind of take that out of the equation for people. But again, I would just say annuities used with caution and somebody that knows what they're doing with them. We've been working and been around these things for the last 20 to 25 years, so we understand them quite well.
Well, Randy and Jake, if people have questions upon hearing this particular broadcast about any of these investment choices, we invite you to give us a call here at Floyd Financial Group. We'd love to sit down with you in a casual environment and talk about your questions and give you the answers that you need. 417-889-7233, that's the number to call. You can do it this weekend. Leave your name and number. Ashley will call you back during the week and set up a time for you to have that casual conversation. No cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233. Of course, we're also online at floydfinancialgroup.com. Time for a break, Randy and Jake. When we come back here, we're going to be talking about 5 blind spots that could derail your retirement when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd Jake Floyd and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we'll be talking about 5 blind spots that could derail your retirement.
Right, and we want to stay on the track when it comes to your retirement. So these are some ones that I think some people overlook, and the first one I think is so obvious you can't see the forest for the trees. It is inflation. Ignoring inflation is a big blind spot. Can you elaborate on that?
Sure. As we've looked back over our shoulder here a little bit, when we had, 9 or maybe even 10% inflation back in, 22, 23, somewhere through there, people were feeling the impact of that. And one of the questions that we got on here one time was, how do you plan for 9% inflation? And I said, you don't. You can't, because you're talking about every 4, 5, 6 years, you need twice as much money to make that deal work, because it's a compounding effect. But yeah, the 2 to 3% range is kind of what the Fed has always looked at. Their mandate, of course, as we talked about earlier, is 2%, because then that means it takes 36 years for it to require twice as much money to live the same lifestyle, if you will, or have the same spending power as you did 36 years earlier. At 3%, of course, it comes down to 24 years, which is still manageable, but we'd rather have it at 2. So again, one of those things we look at is when we retire and we're not able to go out and earn a living, we have to rely upon our investments to cover that. So it's one of the things you need to definitely think about is, where are we today and what's it going to cost in the future? And of course, we have to pair that with, as I age, will I spend more, will I spend less, and how will I spend that money? Will it be healthcare versus vacation and boats and travel and skiing and riding mountain bikes?
Right. Well, 2 to 3% doesn't seem like much, but I think you made a very good illustration as to the effect that had had over the years. And not adjusting investments or income strategies to keep up with that inflation really can shrink your lifestyle. So let's move on to number 2, overestimating investment returns. How many times have you had somebody come in and they say, Randy and Jake, I want 10, 12% return. I don't want to pay any taxes. I want total safety and all this growth. Probably happens every once in a while, but probably not on a very common basis.
Well, you know what they say, Jeff? If ifs and buts were soup and nuts, it'd be Christmas all the time.
Yeah, right.
So
I was going to say, I'm not sure where this is going. We might want to be careful.
So far, so good. We're safe, Randy. Go ahead.
Okay, yeah. So anyway, we'd like to have that. And there's been a few people back in the past, during the 80s and 90s, when they would say, hey, a regular mutual fund will yield at 12 to 15% per year, and you can just live happily ever after. Until 2000 came and we had a 50% reduction in their value. And then, of course, we had 7, 8, and 9 that came along. We had a 53% downturn there. And then, of course, we've had COVID and a few other things come along. The bottom line is looking at what you can actually spend out of a retirement account. The general rule of thumb out there, if you go out to AI and the web, is going to be 4% of whatever your balance is.
Right.
I will tell you, we can do a little bit better at that with a good managed portfolio and really working with the client closely. But again, if you're wanting 10 and 12%, in fact, I will tell you this, if you told me that you need a 12% annualized return, I would tell you that you're at the wrong building and we'll send you down the road.
Right.
Because it's just not going to happen.
Yeah. I mean, there'll be years where we hit way more than that.
Right.
But on average, we're not going to be swinging for the fences with your money. Babe Ruth had the home run record, right? But he also had the strikeout record.
Right.
Nobody wants to be striking out in retirement.
Absolutely not. And we talked about the good growth mutual funds. We talked about exchange traded funds. Historically, over the last 30 years, what would you say the return on investment in an ETF has been?
Well, if you look at the broad market like the S&P 500, you're probably in the 9% range. Again, we have to look at that. Returns are something that's really, depending on where you start, makes all the difference.
Right.
So if you came to me on March 2nd, 2009, and we invested all your money, we tied it to the S&P 500, you did really well. You got lots of money. But if you came to me 3 years prior to that and you put your money in there and you got scared when the market went low, you lost your fanny. So, I mean, it's one of those things where, again, returns are subject to timing in many cases, and sometimes you just come in at the wrong time. Like, if people came in and invested money the end of 2021, right before Jerome Powell started raising interest rates, and the market fell 20% in 2022, people weren't really happy with that. That wasn't a 10% return.
Yeah.
But if you've hung on for a little while after that, we healed up in 2023, then we started to make some money in 2024, and we're starting to make some money in 2025. But it depends on the length of time you're looking, because I can make that number anything you want, from if you look at it for 1 year to 2 years or 10 years to 20 years, and picking the time frame makes all the difference. And I'm not trying to skirt the issue here. I'm just saying that timing is everything. When you come in and we sit down and we talk about it, we're going to develop a program for each individual retiree or a retiree couple that makes sense, that can be carried forward, that's sustainable, and that's what we're looking for.
5 blind spots that could derail your retirement. That's our subject with Randy and Jake Floyd, Floyd Financial Group. Again, our number, 417-889-7233. The other day I was looking at a longevity chart, and I was seeing how much we have gained here in the last 100 years. People in 1925, they were living to be almost 60 years of age. And I saw another stat that said if you're really healthy at the age of 65, that you could live to be 95. So longevity risk is something that is very real and something that we really need to take into consideration these days.
Yeah, for sure. When we set up our withdrawal strategy, and when we look at people's risk tolerance, the amount of money they've saved, their lifestyle, all those things come into play into helping them navigate that. So one of the things that sometimes people don't realize is we have to be realistic here. We are dealing with people's lives, their life savings, and that sort of thing. We want to do a great job for them, and we're not going to blow any smoke. We're going to tell you the truth about what you can expect and not expect out of a retirement portfolio. I can't tell you the number of times that we've had folks come to us and say, hey, I've been with my other guy over here a long time, but my account value is getting spent down. I'm beginning to worry. And sometimes they come to us soon enough where we can help, and sometimes they don't. If you don't know for sure what a good withdrawal strategy should be to manage your money for a long life, come see us. We can help you with that.
Right. With modern technology, with all the things that we have at our disposal, not only that, but the education, we know what can kill us. We know cigarettes kill us, but yet I stand in line behind people at the supermarket or the convenience store every day who are not only buying cigarettes, but they're buying chewing tobacco. But still, despite all of that, people are living longer than they have ever before. So count on longevity. You've got a plan for that, and you've got to have a plan to have income. Next on that is neglecting taxes in retirement. This is a big one because I think that people think, well, I'm not going to pay nearly as much in taxes in retirement. But that's not exactly true, is it?
Well, depending on what your sources of income are, whether you're lucky enough to have a pension, you got Social Security, IRA investments, maybe you got Roth IRAs, maybe you got brokerage accounts, all those things have potentially different tax implications and benefits. So, yes, we need to figure out what's the best strategy to get those people the most income with the least amount of taxes, or the income that they want to live the lifestyle that they are wanting to live. Because, again, just turning on income, while you can do that, it's not quite that simple. If we want to make sure we get you maximum income with lowest taxes, we need to think about it a little bit and work out a good strategy.
And we've mentioned before, and for those people who did not hear it, Social Security is indeed taxed. Can you explain how much Social Security is taxed?
Right. So that's one of the things that comes into play. Depending on what your income is, determines whether none of your Social Security is taxed, or up to 50% of it is taxed, or up to 85% of it is subject to tax. So depending on where your income falls and how you pull income is going to determine that. Also, for some people that are higher incomes, we have to also worry about IRMA, which basically says, hey, Jeff, if you make too much money in retirement, we're going to charge you more for Medicare.
Right. And that's the Part B thing. And, I think for most people listening, it could be around $175 or so. But if your income comes up, you're going to get a pleasant letter that says, guess what? You made too much money. It could be $200, $300, all the way up. I think maybe the highest is like $500, $600 a month.
600 plus.
So that is Aunt Irma, and that is something else that I was going to say. We got AGI. We've got.
She's a real treat.
She is a real treat. We got too many aunts in this house. We got Aunt Aggie, which is adjusted gross income. We got Aunt Irma. Anyway, that is something that we have to consider, is neglecting taxes in retirement. Finally, is failing to diversify income sources. I was hearing a gentleman the other day on another radio show who had all of his stock investment in one stock. He was not diversified. If that stock failed, he lost 50% of his income.
Yeah, that's something that we just really won't do around here. While there's been people like Jake had alluded to earlier, people that bought O'Reilly 25 years ago are smiling all the way to the bank. People that bought Apple back a few years ago, those people are smiling all the way to the bank. But, for every Apple and every O'Reilly, there's 100 others that didn't do that. So when you're relying upon one market, one company, if you will, one segment of the market to provide all your income, we know this. The one thing that's constant is change. That's one of the things that we have to monitor here, and we monitor with our clients every day is what's going on in their life, number one, that changes. Number two, what's going on in the environment that changes, and that's going to all affect markets and economies. What's going on with interest rates, unemployment, all those things affect the outcome and how we need to respond.
Yeah, and then maybe that's one of those proverbs we should have asked the kids is what happens when you put all your eggs in one basket. Of course, when you drop them, they could all break. So you want to have multiple income streams, Social Security, pensions, annuities, investments, maybe even part-time work, rental income. It really does provide flexibility so that if one segment of your portfolio goes down, you have the others. We've been talking about blind spots that could derail your retirement with Randy and Jake Floyd of Floyd Financial Group. Again, if you've got questions, 417-889-7233 or online at floydfinancialgroup.com. Randy and Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about the realities of retirement when our program continues on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in our final segment today, we're going to be talking about retirement realities. And Jeff, I woke up this morning early. I'd had this on my mind for the last, couple of weeks, really, I think, anyway. But I woke up this morning, I thought, there's some questions I have to have answered for myself to be sure that I'm on track and know that I know exactly what I'm talking about. And I think this is going to be very liberating and very informative for our folks.
Yeah, and I think on the surface, it looks quite simple, but when you really break it down like you did at 4 o'clock in the morning, this is really, really interesting stuff. So let's start off with Social Security and the retirement reality of that. Can you expand on what you were thinking at 4 a.m.?
Sure. There's a couple of things that I think need to be brought to light here right quick. So everybody, if you go out on social media, everywhere, he's gutting Social Security, he's raping it, he's this, he's that. Right. All of this stuff that you're hearing. So the last major change to Social Security was made in 1983 by President Reagan when he changed the full retirement age from 65 to 67. So just some food for thought. So there's been no other major changes to Social Security and how it affects people getting the checks. Now, internally at the Social Security Department, yes, they've made some changes. But one of the things I want to talk about here is what is the median versus average. Now, average, is everything divided by 100, right?
Right.
The median, though, is really the middle. Where is it that most people live? And so the median Social Security right now for each individual in this country is $1,883 per month, okay? So if we think about that, if you have a couple in a household, that gives them $3,766 a month times 12 months, $45,192 in Social Security coming in the front door. And I might add that if you were a married couple earning $45,192 in Social Security, guess how much you would pay in taxes? Probably zero. That's a pretty good outcome, right?
Yeah.
So if you were to look at what the average Social Security check is, this is what's skewed by some of the higher paid out people. Because right now, the maximum in Social Security, you can make almost $4,800 a month if you've funded it max all of your life, okay? Which puts you at $48,144. Now, what's interesting about this is there are those that think they didn't have a job that paid them $100,000 a year for a very long time. They're not going to get even close to as much Social Security as their neighbor that lives over in this area, Highland Springs. Mm-hmm. It's really not that far off. It's less than $3,000 for the entire time if they had maxed it out each year. So I thought that was kind of interesting, $3,000 a year and what the Social Security check is actually going to be. So, that's on average. Now, again, that's everybody averaged together. but I thought that was pretty interesting.
Yeah.
Now, the next thing that comes up is, what is the average cost of living in the U.S. today? What would you want to venture a guess on that, Jeff?
Across the entire country, again, you're talking about average versus median, and I understand median. We put everything together. We put Los Angeles, Hawaii, and we mix it with Tuscaloosa, Alabama, and some of those places like that. I'm going to say $68,000, $70,000 a year, something like that.
Yeah, so according to the research I looked at this morning, I looked at SoFi, I looked at the U.S. Department of Treasury, all these different things. About $61,334 is what people actually spend.
Okay.
Now, I went ahead and I averaged 15% tax on top of that. So that means at $70,543 or $5,877 a month, you are average in the U.S. So anybody that's above that, you're doing good. So if we took that first number we came up with, the 45,192,
yeah,
and we figure we need 70,000 and some change, we need about $25,000 of income somewhere else per year when we are retired.
Right.
So if we look at that, if we apply a 5% withdrawal against our retirement savings, that means we need to have about $500,000 in retirement savings to generate that extra $25,000 that we need to be average in the country and living life in a pretty good way. Now, according to SoFi, which is a non-bank bank and an investment company, they say the median annual income is about $66,000, and that the median hourly wage for people working today for men is $28 an hour, and for women it's $24 an hour. I'm not sure why the disparity there, but I will just say this. When we look at that, if we have two people working, that's a pretty decent income coming in. That's $132,000, $135,000 a year. And I hear all too often as I'm out walking in the community and around the neighborhood that people say, well, we just can't live on what we're earning now. And we don't have enough money in things. And so I'm looking at it and I'm thinking, okay, so if retirees are spending $70,000 a year gross before taxes, and the average person out here working is making $132,000, there's a big disconnect here somewhere. Now, what is it? Well, people say, yeah, but I don't have my house paid for yet, and many retirees do. Well, the average housing cost across the country is $2,120 per month.
Okay.
So when I start looking at all these different things, I still think there's lots of opportunity in America, and I think that we do live in the best place on the planet still. Do we have our problems? Yes. But when it comes right down to it, we have a lot of opportunity here. And people say sometimes to me, and you've even asked me this question on the show here.
Yeah. So
what part of retirement does Social Security equal for the average retiree? Well, if we look at the average retiree, 45,000 as compared to 70, it's 60% of their income.
Right.
So now, what's average? Nobody's average, right? So what's the average age that a man lives to in America? 76.8. I'm sorry about the 0.8. But,
well, who's counting?
Right. But nobody wants to be average. So everybody wants to be above average.
Right.
So let's talk about one of the things that I read. People say, what do I need to tell my kids? What do I need to teach my grandson, my granddaughter, my kids? What do I need to teach them to put them in a situation where they can live independently in the future and plan on a retirement, even though we have no idea what Social Security may look like, and pensions will probably be a complete thing of the past.
Oh, yeah.
How does that work? So there's this thing out there called the 50-30-20 rule. Have you ever heard of that?
I know what it is, but I want you to explain it to our audience.
So basically what they're saying is 50% of what you earn should be spent on basic living needs, your housing, keeping the wolf away from the door, keeping your family fed and dressed, right?
Mm-hmm.
And then 30% of your income should be spent on those things that you want to do and have some fun, the entertainment and the extra things that you want to do. And then 20% of your income should be invested or saved. And so I did a little extrapolation on that. If I'm a single person earning this average of $66,000 a year, let's call it 60 for easy numbers, right? So that's $5,000 a month. $2,500 would go for my basic living expenses, $1,500 a month for miscellaneous fun, and $1,000 a month savings. Now, some people are sitting there going, wow, that's a lot of savings. Well, if you think about it, it's only 20% of everything that you're taking in right now, right? And in many cases, you can get that saved tax deferred because you got a good 401k plan. Most everybody can put at least $1,000 a month into that plan if they want to, if they elect to, right? So if you took that money and you invested it at age 25, you're out of college now, you're working or whatever the case may be, and you work from 25 to 65, you invest that $12,000 a year at 7%, you end up with $2.5 million. And that can derive you $125,000 a year in income when you're 65. Well, if the Fed does mandate and keep inflation controlled to around 2%, in 36 years, you'd need twice as much money as you have now, which would be 132. Well, just your savings alone almost gives you twice as much money. So you've kept pace with inflation. Think about this. What if you got just an 8% return on that investment? Now you're at 3.379 and you're 168. You're almost triple your current income. Also, by that time, if you've bought a house, you should have it paid off, right? Because at 40 years, there's no 40-year mortgages I know of in this country.
No,
most of them are 30.
They're probably going to invent those because they got car loans that are 8 and 10 years these days, too.
Right. So my whole point to this thing is sometimes people kind of get to looking at this stuff and they think, man, there's just no way I can get to where I need to be to succeed.
Just not true.
You can.
Exactly.
How do you eat an elephant?
Well, eat the toe first. You just take it one piece at a time.
Right. And so sometimes, and I was having a conversation just yesterday as I was out slaving on the golf course.
Slaving under a hot driver or whatever it is.
Actually, my driver was working pretty good yesterday.
Really?
It was my short iron shots that were no good.
We're slaving before a hot microphone this morning. But yeah, I know what you're talking about.
But anyway, it's one of those things. We've got tons of opportunity in this country.
Oh, sure. Yeah.
Yes, we got problems, but we're making great moves. Things are moving the right direction. I am just really excited about what the future holds. And I want to encourage people. And also, we have people that are listening to this that may be 50 years old today that have gotten a late start and they're trying to think, how can I get to where I need to go? Call us, come see us. Let's talk about it. We can work out a plan to get you where you need to go.
Right. And I think that these are some real eye-opening figures, the retirement realities. And when people say, well, I just don't seem to be able to make it, and they're making a handsome income, you look in the garage and, they've got a $70,000, $75,000 SUV. They've got this new foldable phone, which is $1,800, and they've got the super widescreen TVs, and they got 3 or 4 of those. It's just a matter of living at your means or below your means until you can afford to do these things. And we're a society of instant gratification. We're highly influenced by the things that we see our neighbors have, our friends have, and especially influenced by things that we see on TV. So I think, remember, there are about 3 things you can do with money. You can spend it, you can invest it, and you can give it. If you're looking to invest it and invest it properly, if you're looking for a financial advisor who really does listen to you, who offers actionable ideas that can make a difference in your life, I think you found it right here with Floyd Financial Group. It's Randy and Jake Floyd. We are ready and able and willing to talk to you. 417-889-7233 is our telephone number. Make that call today to request your complimentary, no cost, no obligation, no judgment retirement review. We will meet you where you are, no questions off limits. So make that call today, 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, I've had a great time talking with you today, but unfortunately, we're out of time for this week. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.